Okay, exercise 9-9 is the third installment of the exercise 9-7 trilogy. Remember, we started with this one, and this was a 9% bond selling in a 9% market. Well, now we have a 9% bond in 9-9. We have a 9% bond that is selling in an 8% market. So our bond is 9%, the market is 8%, therefore this bond will sell for a premium. Notice the carrying value at the date of inception is greater than the face value of $500,000. So, given that, we have to go through and we have to look at the amount of premium we will be amortizing each time. Remember, we're still going to be paying 9% times 500,000 times 6/12. We're still going to be paying that amount. Okay, so every interest date we're still going to be sending out $22,500. And that was the number we figured out at the beginning in 9-7 when we had to come up with the interest. 500,000, 9%, 6/12. That's how much we're going to be actually sending out. However, we should be sending out a slightly different amount. We should be sending out 4% of the carrying value, which is $549,482. That's how much we should be spending. That's how much we should be sending out. We're not, but that's what we should be sending out. So we have to look at the amount of premium we're using up. So if you do 4% times $549,482, you find that we should be sending out $21,979. The difference between these two is the amount of premium we're using up. That's going to lower this each time. And the difference between $22,500 and $21,979 is $521. That's going to reduce this. That's the decrease in carrying value. So when we reduce that, we come to $548,961. So after the first interest payment and the first amortization of premium, our carrying value has gone down to $548. The next time around, we should be paying 4% times $548,961. That's $21,958. We're actually sending out $22,500. The difference between $22,500 and $21,968 is $542. That's how much of the premium we're using up, we're amortizing, and that reduces this. We subtract that from the carrying value, and when we do that, we come up with $548,419. So that's requirement one. That's the first year of the amortization plus the initial transaction to record the bond. Well, part two of this says, okay, you've got all these things. Let's see how you handle them. Well, that's how much cash we got when we sold the bond. We got $549,000. We'll be paying back $500,000. The difference, the $49,482, is the premium. Because remember, no matter what you sell the bond for, you always pay back the face value of the bond. Now, we have 2 interest expense payments, and we have 2 amortization of premiums, and they're the ones we worked here. So we need these 3 numbers. So on June 30, our actual interest expense should be $21,979. That's 4% of the carrying value. We sent out $22,500. The difference between those, the $521, is an amortization of the premium of bonds payable. Time flies when you're having fun. Here it is, December 30th. The Christmas season is upon us. We send out another check for $22,500. Get it red and green, Christmas season. The interest expense should have been 4% of $548,961, because this is what you're paying the interest on. This interest is based on that carrying value. 4% of that, $21,958, is our actual interest expense. And the difference between those, the $542, is the amortization of the premium bond payable. That's the last installment of the Splash City trilogy.